The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick here in London with Juliana Tattlebaum, who's made it back to the studio. Yes, she found it. And Karen Cho's made it to Paris. She found that as well. These are your headlines. U.S. and Chinese negotiators reach a framework to revive their trade truce after London talks run late into the night. The U.S. Commerce Secretary Howard Lutnick calls the outcome a step towards stronger trade ties.
First, we had to get sort of the negativity out, and now we can go forward to try to do positive trade, growing trade, and beneficial to both China and to the United States.
UK Chancellor of the Exchequer, Rachel Reeves, prepares to divvy out some £2 trillion in public spending. It's over a period of years, it's not doing it straight away, as the government looks to reset the narrative amid a popularity hit.
The European Union is reportedly set to back Unicredit's bid for rival Banco BPM, potentially going against the Italian government's decision to invoke its golden powers rule. We will hear exclusively from Unicredit CEO Andrea Orcel at 8:30 London time.
French AI firm Mistral AI lays down a challenge to OpenAI, unveiling its first reasoning model, with CEO Arthur Mensch outlining its unique selling point to CNBC.
Historically, we've seen the U.S. models to reason in English, and the Chinese model tend to reason in Chinese. And we've made sure that it actually reasons in multiple languages. It improves everything across the board.
Lovely to see you. We have got an amazing show, actually. We're packed full of top CEOs, brilliant interviews as well. We'll get to that as well. We've also got Ian King on the spending review. Lots going on. Good morning.
Very good morning to you.
Well, I've been taking the mickey about your location finder for days, but you know, because of course we didn't know where the Chinese-US talks were. You found them eventually, which is great. But oh my goodness me, was the presser at 1 a.m. or something?
It was after almost 14 plus hours yesterday.
Which is a really weird thing, because the reason why I say that is because, and we'll come to the story in a moment, and I won't spend too much time on this, but there's not so much on the bones. I mean, the only headline I've got is we've agreed a framework to talk together more, which is brilliant. I mean, we need the Chinese and the Americans speaking to each other rather than speaking at each other, which is great. But unlike Geneva, there's not so much meat on the bones, is there?
Well, exactly. I think the way that the administration framed it yesterday, Howard Lutnick, Jamieson Greer, when they addressed the press at nearly 1 a.m., was that this just builds on the foundation in Geneva, but no written agreement here. We had the reporters yesterday pressing them, do we have a written agreement on the back of these, marathon talks in London? And the suggestion is no, it's basically a handshake here. But I think the point is that we haven't seen an escalation, that the two sides are continuing to talk in that mechanism seems to be working.
And the headline seems to be, and I will move on off this, it's going to be, it's actually quite simplistic, but I think is missing the point. Rare earths for chips. That's all I keep reading. Rare earths chips. More chips allowed from the US to China, and perhaps some of the more basic chips back from China to the US. And that's in return for more rare earths going west to east across the Pacific. Which,
yeah.
I don't know. It's got to be. There's way more issues than that.
Well, there's a lot more issues than that, and Howard Lutnick did say that over the course of that 14-plus hour meeting yesterday, they touched on almost everything he said, but it seems like the real focus here is on rare earths, and we can talk more about this later, but I think this whole episode has really shined a spotlight on just how much leverage the Chinese have around these rare earths, not just for the U.S., but for countries around the world.
Because the West has been pathetic. I'm not talking about the U.S., I'm talking about the collective West, because the Chinese were on this on rare earths 20 years ago. US and Chinese trade officials, as Juliana has been covering, agreed on a trade framework after 2 days of talks in London. In the words of the US Commerce Secretary, it puts meat on the bones of a deal reached last month in Geneva to ease bilateral tariffs. We have little insight, as we said there, on what was actually agreed after talks wrapped up around midnight. What we do know, though, is that the deal adds to what was decided in Geneva last month, where both sides agreed to ease tariffs and ease tensions communication, more importantly, and talk to each other, whilst also easing China's export restrictions on rare earths. China's international trade representative and the U.S. Commerce Secretary offered measured remarks after talks drew to a close.
In the past 2 days, the Chinese and the U.S. teams have had in-depth exchanges. Our communication is very professional, regional, in-depth, and candid. In principle, both sides agreed on implementing the consensus reached by the two heads of state on the June 5th in the phone calls and also the Geneva talks.
I think both sides had extra impetus in order to get things done because we both have our presidents behind us, pushing us to make sure we take care of our respective sides.
But the ramifications of what's already happened since April 2nd, well, this is what the World Bank says about it. It has slashed its global growth forecast for 2025, pointing in particular to the impacts of trade uncertainty. The World Bank now forecasts the global economy to grow by 2.3% this year, down from an earlier expectation of 2.7%, in what the bank said would mark the slowest rate of growth since 2008, aside from outright global recessions.
Let's get to markets and take a look at how Wall Street closed up yesterday. Of course, the U.S. market closed up before we had the announcement from the delegations here in London. We did see all three of the majors end higher. The Dow Jones added about 0.25%, the S&P added about 0.5%, and the tech-heavy NASDAQ also gained some ground. We had 10 out of 11 sectors positive in the session, led by energy, which gained about 1.8%. Now, here's where we are seeing some reaction to those trade discussions in Asian markets, which are trading overnight higher. And it seems like the takeaway from the talks, from the handshake agreement, is that we haven't seen an escalation. This is a step in the right direction. We haven't seen the talks fall apart. As Steve said, we don't have a lot of meat on the bones here, just a framework that's now going back to Washington, going back to Beijing for approval. But the two sides are talking. Things have been conciliatory, it seems, and we are looking at a step in the right direction. That seems to be the interpretation by markets anyway. Hang Seng adding about 1% in the overnight session, the Kospi about 1% as well. As for European futures, this is the picture for the European market open at this stage. We're looking at a pullback across the board. Yesterday, the Stoxx 600 ended little change, and now this morning we're looking at a little bit of down trade this morning. The Xetra DAX looking to pull back about 0.33%. Similar losses for the Italian market. U.S. futures. Let's take a look at what Wall Street has in store for today. A huge day on the data front with the CPI due out later on, and we're looking at a pullback there as well. So similar picture to what we're seeing in European futures. Exchequer has trained 500,000 employees to use generative AI in the workplace as the technology triggers a surge in sales. Our next guest says the firm has changed the way it uses AI to deliver for its clients and is now using it to replace rote tasks. That is Julie Sweet, CEO of Exchequer. Julie, thank you so much for joining us in the studio today.
Thank you, Julianne. It's great to be here.
Let me kick off with AI and how it's impacting your business. There's so many different things we can talk about, and hopefully we'll get a chance to get to so many of them. But when it comes to AI, it seems to be a real double-edged sword for a company like Exchequer because on the one hand, companies will need you to help integrate AI into their businesses, but on the other hand, it's clearly a threat to some extent because it can replace some of the things that you're currently doing for your clients. So talk to us about how AI impacts your business model overall.
Sure, Juliana, so we see AI as just a massive opportunity. If you go back to November 2022, when ChatGPT burst on the scene, we had about 30 people globally working on Gen AI, mostly in our R&D labs. So the first 6 months, we did $300 million of sales. In the last 6 months, we did $2.6 billion in sales. A massive change in 2.5 years. We went from 30 employees to over 500,000 trained on the fundamentals, 270,000 deeper, and 1,100 clients today and growing. So just like prior technology waves, things change, and we are the ones that help lead companies to the change. And so overall, it's a huge opportunity, but not just for Accenture. It's not about Accenture. It's an opportunity because it's an opportunity for our clients. And we're seeing a lot of that here in the UK, whether it's Lloyd's of London or Currys or name, a major company here who are embracing it because they see it as not just about productivity, but productivity and growth, which are the two magic words for CEOs.
Well, speaking about the financial services sector, which is a huge part of the UK economy, we're hearing, from insurers, from banks, that they are, investing huge amounts of money in AI to try to upgrade their productivity, as you said, but also to drive growth. Where are the financial services companies in the journey? It's pretty hard to get a sense because, as a customer, you don't often see the impact that AI is having. So a lot of it is happening behind the scenes.
Well, financial services is one of our largest industry groups globally, and we actually just opened an innovation lab here in the UK. So we're seeing every day what's happening here. And where we see the biggest opportunity today, and it is very early in the journey, continues to be around customer experience and the ability to connect information to the customer and really change, how they're seeing, very personalized advice to them. So that's one of the biggest areas. But I would say to you, it's extremely early. Like, what is going to happen with respect to, for example, most of transactions are still on old technology called the mainframe, right? And when you're able to use Gen AI to move that to the modern technology, how you'll be able to do risk modeling, how you'll be able to understand your customer better will really be opened up, because right now a lot of that information is trapped in very old technology.
It's fascinating hearing this, and actually lovely to chat to you beforehand as well, because we realised, Juliana, that Julie is using vast amounts of AI in her daily life, and I'm using a lot less. So I need to get with the game. But I do appreciate that, and I know it's coming. I'm not a Luddite, but I'm just slow. But Julie, the challenges in your industry are enormous as well. It's an industry which a lot of companies and a lot of governments, they like to dislike, but actually they need it as well. And there's great literature about what the consultancies have done and haven't done as well. But just put us, if you would, as well, we've talked about the great opportunities that AI can help and help mitigate the problems that I'm going to ask you about. But what are the biggest problems at the moment that the industry is facing? There are structural changes. There are governments around the world, from the United States to this side of Atlantic, that need to cut waste. And they talk about cutting consultancies all the time. Whether they can or not remains to be seen.
I think the biggest challenge that the industry faces right now is actually the macro uncertainty. So when we look at, what are we navigating? The reality is our clients are under extreme pressure. It's a big opportunity for us when you think about how we are able to bring productivity and growth. I mean, we have over, every quarter around 30 clients with $100 million in bookings each, right? That is enormous, right? That is an industry of one in terms of like our industry. But what it goes to is that they are focused on the big transformations. And in our industry, we need big transformations, we need small transformations, and there's just constrained spending because of the elevated level of uncertainty. For me, that's the number one, and that's true across industry. When you look at AI, right, the companies who embrace it, including in our industry, I believe are going to be the ones that win. AI is an enormous change for us, every part of the enterprise. And so if you look at an Accenture, we're helping with the grid. We're helping with refineries. We're in the core operations, and we do the enterprise corporate functions. And so our opportunity to help clients is very unique because we can do it in all parts of the business.
You've done a brilliant job of mentioning macro uncertainty without mentioning the greatest source of that macro uncertainty. And I know this is the bit where you're thinking, oh God, how do I get through this one? But you're well trained, so I'm not worried about that. Trump, whether it be Doge restructuring and the chaos surrounding the Musk-Trump relationship, or indeed the Trump administration, we've just been leading on the China talks as well. How concerned are you that US administration policies are creating more uncertainty and delaying capital spending and delaying spending for companies such as yourself?
Steve, one of the greatest things about entering my 6th year as CEO of a global company is that we've all lived through a lot of different macro shocks and developments. And
this feels different this time, Julie. I mean, I've been around a long time. I started in this business in the late 80s or in the markets, and this feels different this time.
Steve, 6 months into my becoming CEO, COVID hit. Yeah. So, again, global company, right? Look, the fundamentals are important. And what we saw today was, yesterday with the U.S. China, is that there's some real desire to engage. And so I think we're all excited about that.
Let me come back to my first question about how AI is impacting your business model and the business model of consultancies across the board. I certainly take your point that over the short and medium term, Exchequer is a real enabler here, helping companies to integrate AI into their business models. But if you're successful in doing that, isn't there an element that long term you're sort of getting yourselves out of this business? If the companies then are using generative AI, that's the whole premise of using Gen AI, you can replace a lot of the tasks that people are doing right now.
Yeah, but they also need someone who's going to provide the great agents, right, who are trained. So think about us. We have a $10 billion business where we operate on behalf of clients. Our experience in understanding processes, right, is enormous. Agents allow us to bring that experience to our clients and make it even better for them, and so it's augmenting humans. So, if you go back to when software as a service was introduced and everyone said it was the death knell of the industry, right, because we all did custom. Well, guess what? We're now doing custom again because Gen AI allows us to actually provide more custom technology at a lower cost, which they then need someone to do. So the important thing is about embracing technology and then using it to solve clients' problems. We have never suffered for decades when we stay focused on what client needs. And then, of course, think about it, 30 people to 500,000 in 2.5 years, right? We're reinventing ourselves and our industry. So I'm super optimistic and excited because of what we see on the ground every day, not the theory.
We're not good cop, bad cop, but she's asking all the nice AI questions, and I'm asking perhaps the ones that you're ready for this as well. Accenture has scrapped its global diversity and inclusion goals after an evaluation of the US political landscape as well. Let me just give you a very quick anecdote. I spoke to a brilliant woman off the record about this, and she is a brilliant woman. She's a top CEO. I'm very proud to know her very well. And she says, we haven't dropped our DEI. We've just called it other stuff. We're just carrying on with the same policies. We have the same ethics about inclusion that we've always had, but we've just dropped the moniker and we don't shout about it so much. Is that how you're doing it, or have you dropped DEI targets?
So in the UK, let's just start here. We're 41% women and 30% in managing directors. We have an incredibly diverse workforce. We are not using the goals as the tool to continue to do that diversity, but we haven't changed our business strategy.
So it's not absolute nonsense, as the president calls it.
It is not. Of course not. It's our business strategy, right? We are one of the most innovative companies in the world. Innovation requires diversity of experience. Think about what we're doing here in the UK with movement to work, with some of our regenerative work, regenerative AI work, where we're providing digital skills to underserved populations. That's all about bringing diverse experiences.
And that's the UK and in the States, trickier to do?
No, not at all. I mean, again, it's very different when we started these goals 15 years ago when we were not a diverse company, right? And so our business strategy is super clear. It's, getting those different skills and experiences a part of what we do. And so not having goals is just that was a tool that we feel we're very mature. And again, it's based on business value, as well as, of course, our values of providing equal opportunity and meritocracy are very, very important to our DNA.
Yeah, brilliant.
Lastly, just rounding out what's going on in the United States, we know that the Department of Government Efficiency has been under Elon Musk looking through various contracts, trying to cut back on spending. I appreciate you're in a quiet period now, but can you give us a sense of the outlook for Accenture's contracts with the U.S. government and whether we can expect to see some of those reduced in the coming months?
Well, we've been really clear in the last quarter about how it's impacting, and we'll give an update when we do our earnings next week. But I always go back to the fundamentals, right? Accenture delivers. Like, our purpose is to deliver on the promise of technology and human ingenuity. That distinguishes us from a lot of other companies because we're about results. And when you're about results and clients, you succeed over the long term.
I've just put in the following into a well-known search engine that may or may not have been using AI, and I came up with the story from January. Exchequer wins £35 million more UK tax work, etc., etc. The UK government's going to make its big spending announcement today. Is it important for you?
Absolutely, because the UK is important. You know, we're investing here. In fact, the UK is the second biggest number of acquisitions that we've done over the last 5 years. So we are investing in the UK. We just got about 6.6, which is a consultancy focused on defense, clearly a very important priority area. So we are here, we are investing, and we're super excited to see not only about the spending, but also the industrial policy that'll be released later this summer.
Julie, thank you so much for stopping by for the conversation. Great to catch up with you. Julie Sweet, CEO of Exchequer. Coming up on the show, fund managers sound a warning over the impact of one part of President Trump's budget bill. Plus, UK Chancellor Rachel Reeves prepares to deliver her spending review with a number of government departments set for a funding squeeze. And we'll have plenty of coverage from Vivatech in Paris through the morning, including a conversation with Manpower CEO Jonas Prising. That's coming up at 7:30 London time. Welcome back to the program. U.S. Treasury Secretary Scott Bessent has emerged as a possible contender to succeed Federal Reserve Chair Jerome Powell. That's according to Bloomberg, although the White House dismissed the report as false. President Trump said on Friday that he would name a successor to Powell very soon. Meanwhile, as the U.S. Senate prepares to vote on President Trump's One Big Beautiful Bill, documents seen by CNBC show American fund managers are lobbying Congress over a provision tucked into the legislation known as Section 899, which they warn could lead foreign investors pulling U.S. investments at speed.
Can I add something before we get to our expert on this one? I read this piece from our expert who's going to talk about it, and I was gobsmacked that it's even in the OBBB bill.
Yeah.
I mean, it's extraordinary. Anyway, this is the amazing thing from the copy.
It's a huge piece that was snuck in here. And Ganesh Rao joins us now from our own team here at CNBC. You've done a ton of work here on how the fund management industry, asset managers are reacting to this little provision. And, you know, when I was reading the analyst commentary over the last week or so in reaction to this little piece of legislation, Deutsche Bank said this is probably the most powerful piece of legislation that's on the table right now because it gives the U.S. administration the power to turn its attention away from trade to capital markets, that this could turn into a capital war. So the impact of Section 899 could be huge. Tell us about what your reporting adds to the story.
Yes, exactly just that. So the trade body that represents fund managers, the Investment Company Institute, is basically trying to lobby Congress into amending the Section 899 before it becomes law. Now, Section 899, just to give our viewers a little bit of a background, in its current form, it aims to target entities from countries that have unfair foreign taxes, like the digital service tax in the UK or the OECD global minimum tax, for instance. Now, as far as I know, there's only a handful of exceptions to where this Section 899 does not apply. Now, what that means is if you're a European investor, your taxes, and you hold US equities that perhaps, say, pay out dividends, your tax has gone up by 5% in the first year if this bill becomes into law. It can go up to 20% over 4 years, and that's on top of existing rules, and in some edge circumstances, that could be 50%. Now, the letter the letter from ICI that was addressed to Senator Mike Crapo, who is the chairman of the Senate Finance Committee, which I've seen, basically is ringing the alarm bells on this.
So again, I find it gobsmacking. So companies that are in the US and companies that want to invest in the US are going to be affected by this. That's the long and the short of it, yeah?
Yes, that's what Republicans in the House want to target. But the way the bill is currently drafted, it basically captures everyone.
This just seems to me, let's shoot ourselves in the foot as a great. I mean, they want more investment. The whole point about the One Big Beautiful Bill and before that irony of it is we want more capital sucked into the US. If you tax foreign companies investing in US and investing in US capital markets. That's the absolute polar opposite, just because of what their governments are doing with Digital Market Act and what have you. That's the polar opposite of what the Americans are trying to achieve, isn't it?
It's the irony there. One bunch of analysts, what they're saying is the US government is essentially trying to ward off other countries from implementing digital service tax or going down the OECD's global minimum tax as a countermeasure to the US tariffs on goods. US already has a large surplus in services, and on the surface of what this bill looks like, it just seems like, as Steve just said, the US shooting itself in the foot. But I think it's mostly trying to counter initiatives in other countries where the digital service tax might come up.
You know, I think it would be extraordinary if this ultimately passes, and the investment community seems to be taking respite in the fact that Scott Bessent is at the Treasury and he is so keenly focused on bond markets. And when you think about the impact,
Scott Bessent's at the Treasury
for now.
Exciting, eh? Well, how about that for a lead in another story?
Potentially shifting roles in the future, according to Bloomberg. That's on the table anyway. But it would be extraordinary if this passes, given the warnings that we've heard from investors, from analysts out there, and given the fact that Scott Bessent is there, acutely aware of the investment community already debating the end of U.S. exceptionalism and the impact that this could have on markets if we see the global investment community now rethinking all their investments in the U.S.